The most dangerous things are the ones we convince ourselves we've already solved. Alan Greenspan said that after the 2008 collapse, and it remains one of the most honest sentences ever spoken about modern finance. Because if you look closely at the system today, you'll notice something uncomfortable. We didn't solve the problem that nearly took down the global economy. We just stopped looking at it. And while the world moved on, arguing about inflation, elections, crypto, interest rates, something far bigger kept growing quietly in the background. Something most people have never heard of, even though they're living inside its consequences every single day. A $600 trillion shadow world, larger than all global GDP combined, larger than every stock market on Earth, larger than every national debt, every bank, every corporation put together. This is the real foundation of the modern economy. Derivatives. They sit underneath everything, invisible, technical, boring sounding. Yet they dictate the price of your groceries, the payment on your mortgage, the safety of your bank account, the value of your currency, even the stability of your government's finances. They were created to manage risk, to make markets safer, to give institutions the power to protect themselves from volatility. In theory, they were brilliant. In practice, they became something else entirely, a structural time bomb. Imagine a safety net so massive that every major institution on Earth depends on it, but no one can clearly map where all the weight is actually resting. That's the core problem. The derivatives market grew far faster than anyone's ability to track it. For years, banks, hedge funds, pension funds, and governments all made deals inside this hidden ecosystem, layering bets on top of hedges, on top of swaps, until the entire system became too complex for even insiders to fully understand. And yet, people assume it's fine. They assume it's safe. They assume that because 2008 happened once, it can't happen again. But the truth is far more alarming. The risks today don't come from one bubble or one reckless firm. They come from the entire structure beneath global finance, a structure tied together by contracts so interconnected that a small shock in one corner can send waves through the whole world in seconds. $600 trillion doesn't become dangerous all at once. It becomes dangerous the moment the underlying assumptions weaken, the moment a few contracts don't behave the way they're supposed to, the moment collateral demands spike, the moment liquidity dries up for even a handful of institutions. That's how real crises begin. Not with explosions, not with headlines, but with small, almost invisible shifts that reveal how fragile the system truly is. And when you understand how this hidden world was built, you begin to see why the next crisis won't look like 2008, because it will be far bigger than mortgages, banks, or real estate. It will be the entire financial architecture shaking at once. And it all starts with the $600 trillion engine beneath our feet. Derivatives didn't begin as some shadowy financial weapon. They started as something simple, almost boring, a way for ordinary people to protect themselves from risk. Hundreds of years ago, farmers used early versions of derivatives to lock in the price of their crops before harvest. If the weather ruined the yield, they wouldn't go bankrupt. If prices crashed, they still got paid. Airlines later used the same idea to stabilize fuel costs, making sure one spike in oil wouldn't destroy their business. These contracts were practical, logical, and genuinely useful. They existed to make the world a little steadier. But in the 1980s, Wall Street saw something else in these tools: potential. A new frontier. The decade was full of financial experimentation powered by fresh computer models, rising global markets, and a belief that math could conquer uncertainty. Economists and traders began reshaping those old hedging tools into something far more complex: options, futures, currency swaps, and interest rate swaps. Each one wasn't just a way to reduce risk. It was also a way to trade risk, to profit from it, to turn uncertainty itself into a product. By the 1990s, the creativity accelerated. Financial engineers started designing synthetic credit products, contracts that didn't just track real loans, but created new ones on paper. You could bet on whether a company would default without ever lending them money. You could bundle risks, slice them apart, and sell them to investors who barely understood what they were buying. And because these contracts lived over the counter, traded privately between institutions rather than on public exchanges, almost no one outside the system knew how big it was getting. Then came the Big Bang moments. Deregulation opened the gates wider. Lawmakers believed that innovation would make markets safer and more efficient, so they removed many of the guardrails that kept derivatives small and simple. The Commodity Futures Modernization Act of 2000 officially ensured these contracts would stay largely unregulated, treated as private deals between sophisticated adults, even though those deals now powered the entire global economy. Once the rules loosened, the growth became unstoppable. The notional value of derivatives shot past $100 trillion, then $200 trillion. And before anyone could understand the full implications, the market swelled past $600 trillion, an amount so large it barely seems real. What began as a tool for farmers had become the invisible engine of modern finance, a system built on math, trust, and the belief that everything would keep working exactly as designed. But what happens when a system grows faster than the humans trying to understand it? Banks love to say that the $600 trillion tied up in derivatives isn't real. They repeat it in interviews, in risk reports, in speeches meant to calm investors. And on paper, they're right. Notional value, the headline number everyone hears, isn't the amount of money actually changing hands. It's the value the contracts are based on, a kind of reference point, a placeholder. The real money involved is smaller, buried in the fine print, triggered only if certain conditions happen. But that sentence, notional isn't real, becomes meaningless the moment the system is stressed. Because notional value may not be cash, but the obligations behind it are. And history already proved how quickly those obligations can explode. In 2008, AIG was considered boring, safe, too conservative to ever threaten the global financial system. Then one week in September, everything changed. Their derivative bets went the wrong way, and the company suddenly owed tens of billions of dollars it didn't have, overnight. The contracts that were just insurance turned into a real bill so enormous the U.S. government had to step in and rescue the company just to keep the system alive. That's what happens when notional becomes real. It doesn't grow slowly, it snaps. And that was when the market was around $500 trillion, already massive but far smaller and less interconnected than today. Right now, the derivative web is even more tangled. Banks don't just trade with each other. They trade with hedge funds, insurers, pension funds, foreign institutions, and thousands of private credit players operating outside traditional regulation. A shock in one corner can ricochet globally in seconds. When one contract fails, it pulls on another, and that one pulls on 5 more. The system behaves less like a network and more like a spider web spun too thin. Everything connected, everything stretched, everything depending on everything else. That's where the real danger lies. Because in calm markets, all these contracts behave exactly as expected. They hedge, they balance, they cancel each other out. The chaos stays contained. But financial crises don't happen in calm markets. They happen when fear hits, when prices move together in the same direction, when every bank, fund, and institution tries to grab collateral at the same time. Traders call this moment correlation going to 1. It's when all the mathematical assumptions behind the $600 trillion system fail at once. And in that moment, notional value stops being theoretical. It becomes a chain of real, immediate payments demanded from institutions that don't have the cash. In quiet times, $600 trillion is just a number. In stressed markets, it becomes a bill, instantly, and someone always ends up paying it. The scariest part of today's financial system isn't the size of the debts or even the speed of the markets. It's the leverage hiding in places most people never look. After 2008, regulators tried to make banks safer, higher capital requirements, tougher stress tests, tighter rules. And for a while, it worked. Banks did become more careful. But instead of reducing risk, the world just moved it somewhere else, into the shadows. That's where the private credit boom came from. Trillions of dollars now flow through asset managers, private lenders, and investment funds that operate outside the old banking system. They lend to companies that can't or won't borrow from banks anymore. They structure deals that no traditional lender would touch. And they do it all without the oversight, liquidity requirements, or backstops that banks are forced to live with. On the surface, it looks like harmless innovation. But underneath, it creates a world where massive risks build quietly, unnoticed, until something snaps. And the leverage doesn't stop there. Wall Street invented new tools to magnify returns without technically borrowing money. Total return swaps allow funds to control huge positions with only a fraction of the cost. Treasury futures basis trades, a strategy used heavily by hedge funds, create enormous hidden exposure in the supposedly safest asset on Earth. Structured repos let institutions stack layers of borrowing on top of assets that already belong to someone else. These may sound technical, but the reality is simple. They are ways to create risk without calling it risk. What makes this even more unsettling is who's indirectly tied to all of it. Pension funds, insurance companies, sovereign wealth funds, the institutions that hold your retirement money, your future payouts, your country's long-term savings, all buy into products that depend on these hidden layers of derivatives and synthetic leverage. They aren't trading the risks directly, but they're connected to the people who are. And when things go wrong, the losses don't stay in one place. They spread. This is where collateral calls come in, the silent mechanism that turns market stress into a full-blown crisis. When asset prices fall or volatility spikes, institutions have to deliver more collateral to prove they can still honor their contracts. If they don't have the cash, they sell what they can. And when everyone sells at the same time, even safe assets start to fall. The system cannibalizes itself. It's easy to think modern finance sits on solid ground, that after 2008, the foundation was rebuilt stronger than before. But when you look closely at how much of today's economy depends on borrowed money, borrowed assets, and borrowed confidence, you realize something uncomfortable. We didn't build a safer world. We built a financial skyscraper on borrowed pillars. Crises never start with the thing everyone is watching. They start when something small shifts in the background, something that was stable yesterday but suddenly isn't. And right now, the most dangerous shift is the one happening in interest rates. For more than a decade, money was basically free. Loans were cheap, risk-taking was rewarded, and investors built entire strategies on the belief that rates would stay near zero forever. But when rates rise, the cost of every promise in the financial system rises with them. Companies that looked healthy begin to struggle. Borrowers who seemed safe become stressed. Liquidity, the lifeblood that keeps markets moving, starts to dry up. This is exactly where the first trigger could appear. The private credit world is filled with companies borrowing at high interest rates with very little room for error. A Renovo-style collapse is no longer a random accident. It's a preview. Imagine one of the giant private lenders sitting on tens of billions in loans, suddenly admitting it can't meet its obligations. That alone would shock the market. But the real danger isn't the default itself. It's what the default triggers. Because when one lender falls, everyone connected to it is forced to reassess the value of their own assets, and when valuations fall, collateral calls begin. Another possible spark comes from sovereign debt. Japan, Italy, and several emerging markets are balancing on the edge of debt loads that only make sense in a world of low rates and constant stability. A small jump in yields, a weak auction, a sudden loss of investor confidence. Any of these could cause a country to wobble. And when a nation carrying trillions in debt stumbles, global banks feel it instantly. Their derivative contracts reprice, their hedges move against them, and the system tightens like a fist. But the most terrifying trigger is the one that barely makes news. A derivatives mismatch inside a major bank. It only takes one error, one miscalculated swap, one mispriced option, one hedge that fails, to create billions in instant losses. From the outside, it looks like nothing. But behind the scenes, that bank must suddenly deliver collateral it doesn't have. So it sells assets. Other banks notice and sell too. The stress jumps from institution to institution, faster than any regulator can respond. The world today is so interconnected that a failure in one corner doesn't stay contained. It forces margin calls everywhere else. The entire system responds at once, like a nervous reflex. And that's the truth most people don't want to hear. The next crisis won't start with a dramatic explosion. It won't look like 2008 in the beginning. It will look stable, calm even, until the moment it's already too late to stop. When a system built on $600 trillion begins to unwind, it doesn't feel like one crisis. It feels like everything cracking at once. Mortgages suddenly become more expensive as interest rates swing wildly. Pension funds, built on the promise of slow, steady returns, watch their safest assets fall and their complex hedges turn toxic. Stock markets lose the illusion of stability as companies struggle to refinance debt that once looked cheap. Currencies swing violently as investors try to escape risk, only to discover there's nowhere left to hide. Even governments feel the pressure because their borrowing costs rise with every ripple of fear. A derivative meltdown doesn't stay inside Wall Street. It leaks into the daily lives of millions. Central banks will try to stop the bleeding. They always do. They'll print money, open emergency funding windows, pump trillions into money markets, and activate global swap lines to keep foreign currencies flowing. For a moment, it will look like they have control, just like it did in 2008 and again in 2020. But each time they intervene, the tools become weaker. The system gets bigger, more complex, more leveraged, and the medicine that once saved it starts to lose its power. Sooner or later, the world hits a crossroads. There are only three real paths when a crisis of this scale arrives. The first is inflation. Massive inflation. Central banks can choose to save the system by printing whatever amount of money is needed to plug the holes. It keeps banks alive, but it destroys the value of the currency. Everyone pays for the bailout, not through taxes, but through rising prices and falling purchasing power. The second path is a systemic default cycle. Instead of printing to save everything, policymakers let the weak institutions fall. Companies collapse. Pension funds take losses. Governments restructure their debt. It cleans the system, but at an enormous social cost. And then there's the third path, a global reset. A full rewrite of the financial architecture. New rules, new currencies, new backstops, possibly even new institutions to replace the ones that failed. It's the most extreme scenario, but also the one that appears in every major turning point of economic history. When a system becomes too complex to manage and too fragile to trust, the world eventually chooses to rebuild instead of repair. What makes this moment so important is the truth it forces us to face. Crashes don't destroy systems, they expose them. They reveal what was already broken beneath the surface long before anything collapsed. And when the next one arrives, the world that emerges afterward won't be shaped by fear or panic, but by the uncomfortable questions we avoided for decades. The $600 trillion time bomb is only the spark. What matters is what we choose to build from the ashes.